So, I mean, really, I guess the theme from this week was to remain calm. And I've had the channel, Independent Investor Channel, on for just over a year now. And, I remembered coming off the last real big downturn in the stock market, all the way back really in 2009, 2010. I mean, it was pretty nasty. And I think a lot of people got really complacent and lulled to sleep in the stock market. But this is really kind of reminding people a lot more about, about the normality in the stock market. Now, I got to tell you, March in the stock market was a little bit more volatile than normal. I deployed some of my defensive techniques, and honestly, I mean, it's a technique that I use just to almost just throw in the towel, because if you can't invest in the stock market and avoid temptation or ignore a lot of the noise out there, you have to understand, and none of that stuff is generated at all to help you. Okay. Now they're trying to buy into a pulse of the stock market. But anytime a company like Facebook or anytime a company like Amazon gives the news media an excuse to really jump on the bandwagon and start exploiting, what's going on. It was always data breach with Facebook, this week. And it's like, okay, what data? Most individual users of Facebook, they opt to allow, a lot of data to be shared or to be analyzed with the sake of using for advertising, not only on yourself, but also within your connected communities. So, and that's something that I accept as a Facebook user. You guys have to understand that last year was actually my very first year on Facebook. I'd be upset, I guess, if, personal information, not data, as they called it, in the data breach got compromised. But, I have no fear of that at all. And, to go in there and have control over what's released over Facebook, I think is really the key here. And, it's I don't know, it's frustrating, certainly. But when I started the channel and I started, really informing people, look, that this isn't normal. Okay. We've been on a huge bull run. And when the market starts to get volatile again, it's going to really test a lot of new investors out there. And I believe it's doing that, but that's why I always said, if you're going to go into a downturn in the stock market, do so with quality stocks that have proven themselves over the test of time. And I think a lot of people still get caught up in the mindset that they need to pick the perfect stock, and that just couldn't be further from the truth. I always try to offer, the best of breed from any of the sectors. Hey, Rob, what's going on? Yeah, I mean, we're just chilling on a Friday talking about the volatile stock market. I mean, there was a couple of moves over the last couple months that were record setting. I mean, a couple 1,000-point moves. That stuff is fairly abnormal. And I really think the market's trying to settle into a lot of things on every level that can affect the stock market. Geopolitical, you've got a tax injection. We do have earnings season coming here shortly. And I think it's going to be record-breaking earnings. So hopefully that kind of settles things down a little bit. But a few things that got brought up this week a little bit. I said we were going to air some dirty investment laundry this week. A few things that got brought up through the group. First of all, I just want to thank everybody. So much good information. And you guys have to understand the information that's flowing through the group is really, really impressive. I'm so happy with that. I've got new investors on there that I know are benefiting. They may not understand why they're benefiting, but I talked to Sarah, one of the new ones. I believe she's a new investor, but she's in the group as well, and hit me up with the question about Disney, and she kind of said, "Look, I'm down 11%. Gosh, you hate to buy a stock and see it go down." But the perspective that I gave back to her was, look, I've been invested in Disney for over 5 years now. There hasn't been a day that I've lost sleep over owning Disney. It's a wonderful stock. The reason why I recommend it so heavily now is you're probably getting a very good entry point while it's hovering around this $100 mark. And I think some of you guys did jump on the recommendation, got it sub 100. So thumbs up on that. That was a great injection point. It's one of those kind of perspective things to where, me invested in a stock for 5 years, you just look at it like, gosh, I just want to invest in the stock and I'd like to see it go up. But you haven't, been in the stock while it's been kind of hovering in this trading range. So you're really getting a good entry into the stock, even though it's down 11%. I said, just stay the course with it. There's no stock that you're going to buy to get a pulse after a month of investing. No way. Really, a month means nothing. It means nothing. And that's before before you pull that buy trigger, really ask yourself a few questions. Number one, am I avoiding overexposure before I hit the buy button, right? Is this a stock that I'm willing to take into a downturn, right? Is it a name that I know and I'm comfortable with? I understand the business. You don't have to be an analyst, but you do need to understand that if it's a stock that you're going to invest in, it needs to resonate with you. All right. So along the lines of the dirty laundry that I want to talk about, number one, the topic got brought up this week on Robinhood. You guys have to understand, I got in trouble quite some time ago with Scottrade. All right. Insofar as that I was trading in and out of stock, ended up getting a letter from the IRS in the mail. You owe X number of dollars to the IRS. It scared me. And I think Robinhood is a fantastic app, very disruptive for some of the folks that I know. I know Scribner uses it because he's ineligible to do the Roth contributions because I think his income is above that contribution limit. So for a guy like that can't contribute to a Roth, or is ineligible to do so, and he's smart enough to get the idea of investing in Robinhood and holding those assets well beyond the 1 year that it would take to get into the long-term capital gains tax if he were to ever sell the stock, right? So in that particular situation, it can work for you, all right? So it's a great app. The problem is, and I know you guys hit me up and say, good grief, Ryan, for somebody that has $100 or $200, they should probably go with Robinhood because a $7 or an $8 entry fee to a stock is worth saving to go with Robinhood as opposed to opening the Roth IRA. And I can't disagree more with that. I can't. You're applying a short-sighted opinion to just saving an entry fee when our goal when we start should be to enter the market passively, okay? I don't want anybody at all thinking that they're going to get started in the stock market and start trading stock and quit their day job, okay? That type of stuff is not something that anybody that's a responsible investor is going to teach somebody new to get involved. What I want you to do is I want you to set $1,000 goal. That's what I want you to do. I want you to get to that first $1,000 saved. I want you to get up to that first $5,000 saved and that first $10,000 saved. And I think some of you guys were hitting me up like, Ryan, it's easy for you to say you trade for free in the account. But guys, I've been doing this for 25 years. Okay. I've earned the right to be at those levels. And I don't want you to invest with the short-sighted opinion of saving an entry fee and not thinking that you're going to actually be at those financial thresholds at some point in your life. That is key. And yes, you do need to join the group. Absolutely. It's my plug for my Facebook group. It's really cool. I never really would have thought, and I think Scribner said when I started, he was like, it's about freaking time, and I'm kind of seeing the benefits of it. I really am. I think it's a great point to drop the information on there. So absolutely, man. If you have not joined the Facebook group, I don't allow advertising. I don't allow video uploads. I've had a few of my members, man, some longstanding folks, put some related content on the group. I would like to keep that free of video uploads. If you wanted to start your own page, that's a better way to do it. I have it. I have the Independent Investor Channel page, and that's actually where all the uploads go right away. When I plug it into YouTube, I actually plug it onto the Facebook page as well. which gets pretty good response. But I'd like the Facebook group to actually just be, Instagram. Hey, the problem is I've got to hit my daughter up. She's got to teach me how to do all this stuff, Nyla. That's the problem. I kid you not, I was not on social media up till a year ago, and I'm really understanding the power of having your content on multiple platforms. Snapchat is in there as well, Instagram certainly, and then also owning your own website is very important. But I feel like I'm meeting a lot of what I want to provide to you guys in way of resource as a single drop point in the Facebook group. It's easy. I can drop it in there. I can generate dialogue. So I'm not quite there yet. And quite frankly, I don't do this full time. I do this more than part time. This is a project for me. And the only initiative or the driver for me is just helping folks. That's it. So it's what keeps me going. If nobody had received or was receptive to the message, I would have just shut it down. I mean, there was no reason for me to do it. The incentive for me monetarily is actually quite low. Hopefully things kind of break loose. But when we were talking about starting the YouTube channel, Independent Investor Channel, we figured, okay, number one, it's a business that you can start with no overhead. It has nothing but upside potential. You do that every single time, with very little downside risk. I mean, what's the worst that can happen, So even though there is a little bit of capital in the channel, I really don't worry about recovering that over time. The question is just how much, recovery is going to take place over time. Brian says, sub to your channel for a long time. Thanks for the info. I see you recommended buying the entire market through an ETF or index. Why not focus just on dividend stocks? Seems safer. This is an awesome question. Actually, I've got this on my dirty laundry to address, but I'll address it now since Brian asked the question. I give 5 portfolio options. All right. And really, I'm not one of those guys that sits back and says you have to invest one way or the other. Okay. I've talked a lot of my catalog of videos about understanding the benefits of both, but I think it's a much more in-depth answer that I could give if you in fact had a 401k or 403b, or in my case, a TSP as a military investor, right? If you've got that baseline and you've already got that market, right, in that baseline portfolio, then you can kind of use the self-directed account as more of a single stock account, kind of the tip of the iceberg. The problem, Brian, is this, and I fear that a lot of people get invested in the stock market. They'll invest in a couple, 2 or 3 stocks that go up. Stocks go up, okay? Stocks also go down. But when somebody new to the stock market buys a stock and it goes up 20%, the problem is you sometimes fall victim to thinking that you can consistently, repetitively repeat stock picking. And that's not possible. I mean, the statistics show that money managers can't do it. So I'm not going to teach a new investor that, picking dividend stocks or single stock is advisable in all cases. Okay. I have to teach that getting a passive program in place first is the correct way, because what you're buying with that passive approach that you're not buying with the dividend stock approach is that you are diversified over here. With dividend stocks, you are not diversified at all. You're not. Okay. So that's why I kind of talk about, if you wanted to do a completely stock portfolio, so be it. But what I would like to see you guys try to do is acknowledge, if you have an existing retirement plan with your work and it's already working for you, let's say you've got 10,000 in there, or 20,000 or 50,000 or 6 figures in there, then the self-directed account can be beautiful for you in that you can afford to take on a little more risk in that. Put some dividend stocks in there, maybe put 5% of that particular portfolio in Facebook, or something a little more aggressive, but we've got that fundamental base. Okay. I really try to teach along these premises. And, if the self-directed account is all you have, I really contend that the year-over-year performance that we're going after in that passive approach is 8%. That's what we're trying to achieve, okay? And the market historically, if you look at these ETFs, not so much into index funds anymore, guys. I've kind of moved away from, as I've really separated the difference between ETF investing and index fund investing. I just like ETFs better. Lower expense for a similar, if not an identical product. I just don't see any reason to buy into the index fund and be subject to the required minimums. But I hope that answered your question, Brian. It's a great question, and I'm glad to kick it off. That was actually one of the things I wanted to address with you guys, because when you're looking at portfolio building, you have to kind of look at holistically. You know, if you're single, if you're married, what does your spouse bring to the table? What do you bring to the table? How do the portfolios work together? Let's say your spouse one has a good 401k, you know, you are self-employed, right? And you don't have a retirement started. Perhaps maybe those two can mirror each other in that you start the self-directed Roth, and your spouse holds, you know, your retirement account through your 401k, and maybe start her a 401k or her, the spouse. Sorry about the terminology, but you kind of get my point, right? If you own a 401k and you're eligible to start that Roth, man, I'm all about starting it. Even if you start it with $100 a month, man, do it. You're going to be glad. Let's say you've got $100,000 in there when you retire. You know, it's one of those things, man. I'm just providing options for you guys. And then, of course, I talk about the 50-50 blend and all that on all those options. So it's really kind of up to, you know, your risk tolerance, your income. So there's a lot more to answer that question, but I do tend to stay a little bit close on the vest in insisting that the best way of investing in the stock market is the proven way of investing in the stock market, and it's proven. That's the passive approach. I got a question here from Baba. What's the best 3 ETFs to own? VTI. VTI is my favorite. It's a total stock index. It's the great entry level. The VOO is my next favorite. My Vanguard, I put the Vanguard link to the ETF page, and if you just go there and look at the 10 ETFs or 12 stock large cap ETFs on Vanguard, you can look at all the ETFs, bond ETFs. You can go all the way down. I own VPU, which is the utilities ETF. It's been crushed, no doubt about it. So I don't really recommend going with a technology ETF or a healthcare ETF. Unless that's something that you guys want to do, you want exposure to those, that's fine. But I'd rather see you go ahead and buy the diversification. That is what you're buying. Do not underestimate the power of that diversification. And if I was going to do the third one, I would do VYM, which is the Vanguard's dividend payer. I believe I got that ticker symbol. I'm pulling it out of memory, guys, but you'll see what I'm talking about. The MGK, I believe, is a mega cap ETF offered by Vanguard. But if you go on there, you can kind of compare for yourself. Most of these run at a year-over-year return of around 8, 9. VOO is at 15, but that's a little bit jaded in that this fund has only been started since 2009. Whereas the VTI started and was incepted close to the early 2000s, 2001, I believe, right? So you can look at those year-over-year returns. And if you have a question about a specific ETF, bring it up and hit me up in the Facebook group. Those are some of the things that you guys miss out on if you are not part of the group, all right? Yvonne hit me up. I've read recently that you shouldn't purchase the largest companies in the world because they've already exhausted their growth. I purchased Apple, Microsoft, Google, and JPM as a start. Was this a bad move? No, it's not a bad move at all. And I think what somebody is kind of touching on there is the difference between growth and value. Okay, there's a completely different, and I don't want to see you guys weighted. A weighted portfolio with nothing but growth is going to be comprised of Nvidia, Amazon. It's going to be Netflix. It's going to be CRM, Salesforce, no dividend payer. That's on the growth side of the house. Now, I'm not saying that, respective of your situation, if you've got that fundamental base, that you can't branch off and add some of that growth to your portfolio. I just bought Amazon this week. I bought it for the long term. I've been wanting to buy Amazon for a long, long time. And I bought it at a bad time. It's fine. I say it all the time. I wanted to invest in the stock more than I wanted to get the perfect entry point. But I did want to buy it on a slight pullback, and I think I did that this week. But Facebook, that's in that group. Google, same thing. But you do actually have some growth and income in your portfolio that you gave me with JP Morgan and Apple. Microsoft, same thing. I think Microsoft right here is actually very, very attractive. So depending on how much investment capital you're starting with, you're a little heavy tech. I tend to try to remain out of a $10,000 portfolio, keeping it around 20%. So out of a $10,000, $2,000 invested to financials, or excuse me, to your tech, and then start to branch off and buy. You've got JP Morgan there. I would consider Bank of America. I would consider Citigroup, which is probably my favorite in the space, and then also Wells Fargo. So, add some financials, add some healthcare, add some oil, add some industrial. It's that you're trying to build a portfolio with a little more broad-based perspective. And what you've got there is heavy tech. And I think a question got brought up this week on the Facebook group talking about my recommendations for ExxonMobil and General Electric. And you guys have to understand, I own them both. They fit into my portfolio along with my other industrial holdings. But there's a precedence in sectors. I'd rather see you go with technology first. That's the most important sector, in my opinion. And you want to try to look at that sector and pick the very best out of that sector. And for me, it's Apple and Microsoft, and it can potentially stop there. If you were going to add more value to that portfolio as opposed to growth, I would certainly look at Cisco and look at Intel right now. But if you were nervous about owning Google on the long, I really wouldn't be. I own a 6% position in Google, right around. I think I've got 11 shares of Google right now. I own every stock that you put up there on the board. I did take some profit in Microsoft when it hit $90. I mean, hell, I got into Microsoft sub 50. So I had some pretty good, it was almost a doubler for me. So I did take some profit there. Probably a bad move, to be honest with you, but nah, your portfolio is just fine. I just think you're really heavy weighted tech. Brian says he sent a request. That's good. That's awesome. I'm glad to have you guys. No doubt about it. I hear other YouTubes calling ETFs risky. Should the market crash? The market's not going to crash. First of all, and I don't invest with the fear that the market is going to crash. Are we in the midst of a 10% correction? Yeah, it's the second of the year, but corrections are perfectly normal. You have a hard time getting out. What are your thoughts? Thanks, Tom. Appreciate the question. Actually, that's all wrong. What you're hearing from other YouTube channels, because what that alludes to, Tom, is an ability to time the market. And honestly, I watch some other channels and I want to puke in my mouth, honestly, because they're giving people wrong information. They're wrong. When I started investing, ETFs did not exist. You did not have the ability to enter into an investment vehicle at such a low cost, which Vanguard offers, to buy the entire market. They didn't exist. The only thing you could do is with mutual funds, and mutual funds are kind of becoming a thing of the past, whereas I'm really a big advocate of ETFs. Now, that doesn't mean that your entire portfolio has to be comprised of the VOO. It doesn't mean that, but it does mean that your fundamental base really should be a very good S&P 500 ETF. And for me, the best one that I found is VOO. I've seen some others recommend SPY. That's another good one. But when I compare the two programs, I don't think anything compares to VOO. And they're very similar products. As far as the market correcting, look, here's the thing. And this is what I get hit with all the time, Tom. And this is what separates me from the rest of the group on YouTube, is that I put more value in the bucket that you own, the bucket, okay? So many people want to go out there and they want to seek help financially from a financial planner. That is going to cost you hundreds of thousands of dollars, depending on how early you get started. Second of all, you watch those other YouTubers, and what the underlying message of that is, Why don't you wait for a pullback? Or why don't you wait for a correction? Why don't you buy into the ETF at a more opportune time in the market? None of that stuff is possible because it all alludes to timing the market. And that's not a strategy that I can get behind. It's not a fundamental premise at all. Furthermore, if you go into that financial planner and you say, look, I've saved up $10,000. I want to invest my nest egg. What are they going to tell you? Are they going to tell you, go ahead and invest in ETFs because that's the lowest cost product? Hell no. They're going to take your $10,000. They don't care if you have sleep easy money at night. They're going to take that $10,000 and they're going to drop it into the most expensive mutual fund that they can offer you. I've seen it done, guys. It's happened to me. It's happened to family. It's happened to way, way too many people that I work with, my colleagues, and it's happened way, way too often amongst the community that we are all trying to educate together, not only each other, but ourselves as well. And so that's a very awesome question. I don't know what to tell you. Unsubscribe. I've had a few people telling me that they're tired of the BS. Look, I run an unscripted show. I don't actually have an incentive, and I'd like to keep it that way. Really, the cool thing about my channel, and I will never compromise this, is selling some sort of course for my material. Why? Because I believe that a lot of the information that I provide is readily available for free if you want to know about the stock market, right? It just sometimes helps having somebody offer a testimonial from somebody that actually invests in the stock market and has actually succeeded, right? I often feel like sometimes if I got on here, I would seriously have, so many more subscribers if I told everybody that I lost my $350,000 that I've got in the bank. You know what I mean? And it's not, it's the shock factor that people gravitate to. And a lot of the time, the people that are really sincere about tuning into the channel really just want to know some simple answers to a more complex or a perceived complex topic like investing. Everybody I talk to that wants to get involved in the stock market says, no, I can't do that. I'm scared. I can't do it. And that it could not be further from the truth, because investing has to be looked upon as something that you have to do, like insurance, right? When you go out and you shop insurance, you're looking for the lowest cost premium with the best possible coverage, right? It's the same thing with investing. So if somebody can tell you the best way to invest in the stock market, find the very best bucket, fill that bucket with the very best assets in that bucket, and then leave it alone. Leave it alone. And people can't get those two things right. And that's why we came out with the channel, so we can massage the topic. We can readdress and reemphasize those important things. So somebody who knows absolutely nothing about the stock market can listen to my 25 years of experience. And I'm a pretty good teacher. I do this stuff at work, so I can streamline information for you guys to be like, you know what? Geez Louise, what Ryan's talking about is making sense. If I'm going to invest, wouldn't I rather put my money into an account where I do not have a middleman? I don't want a middleman. I don't want it. And there's a ton of people out there, when I say that, their eyebrows raise, and I can see the light bulb go on above their head, and they're just like, tell me more a little bit, because a lot of people don't know that this stuff exists, man. They don't know. Right? So back to the ETF question, right? That's why you've got YouTubers out there trying to find that magic entry into the stock market. They're underestimating the most important thing about entering the stock market, and that is to do so in a passive, long-term, self-directed Roth IRA account. For anybody that's starting in the stock market, you've got a few $100 to start. That's the very best place you can start, and that allows you to eliminate the fees in the account. You can't resonate with the value of that unless you run those figures through my compounding calculator that actually accounts for the expense ratio that's charged in a traditional account. Guys, if you haven't watched Tony Robbins, he's one of the folks that I gravitate to, and I repeat some of his stuff. Why? Because it's worth repeating. Industry standard for money managers is between 1% to 3%. My compounding calculator allows you to put that 3% in there and compare for yourself. Compare for yourself what it's going to mean over time to actually put yourself in a fee-based account or a fee-free account, right? So once those dollars are able to generate, right, in that account, then they can grow wealth preserved the way they're supposed to grow in a compounding effect. But so many people put the horse before the carriage. They want to put all the value on picking that magic stock. Ryan, you said invest in ExxonMobil. I'd rather invest in Apple. My thing is, if you take either one of those good quality blue chip stocks and house it in the self-directed Roth IRA account, that's going to be so much better than going to your bank and buying a bond account, right? I would much rather buy ExxonMobil off its highs of $96 here in the low 70s. Maybe you get 20% of capital appreciation out of the deal, and you do so being paid a 4% dividend in your self-directed Roth IRA, and it's a Dow component, right? So it's a mindset that you've got to kind of think about, and this really could be the best information that's offered online for free, and that's why a lot of people through referral are bringing them to my channel, because if somebody reaches out to me directly, I'll bend over backwards to try to kind of show you, like, hey, maybe this is the focus over here. Right now, your focus is right here. Maybe your focus needs to be right here. All right. So I'm gonna get to a few more questions, guys. I hear, so that's the YouTube one. I'm just gonna scan through here, guys. Looking to add a chip to my self-directed Intel or NVIDIA, or maybe both. So one's an incredible growth name, one's an incredible value play. You could do both, but I want you guys to understand it has to fit. Okay, it has to fit. So don't just hear it from me. If I tell you to go buy, they're both phenomenal companies. NVIDIA is one of my favorites. I don't own it. Okay, I don't. I don't own Intel right now either. I bought it in the low 40s. I took a trading position in it. I exited the position at 50. I took my profits. But both phenomenal companies. I endorse them both. Chips are kind of getting beat up right now. I don't know if I would devote, why don't you think about putting a smaller position into NVIDIA from a growth perspective, and then putting a little bit bigger bulk on the Intel, because Intel is going to pay you that bigger dividend. And I actually think Intel right now is actually a better value. So thank you for that question. Yeah, not worried about them long term. Just curious about your opinion. Thanks. No problem. That's awesome. I own every stock you hit up there on the board. And this is another thing that's cool, guys. I'm the most personal guy. It's funny to me to be doing this, honestly, because I keep to myself. So I don't want you to take it the wrong way when I say I own all those stocks. I've had a lot of practice on this, guys, and I've made a ton of mistakes. My video that I'm releasing on Sunday is going to be my top 10 mistakes, and you guys are going to want to tune into that, because it's good. It's a good snapshot, within 15 minutes, and it really walks you through some of the mistakes that I've made, and encouraging you guys to avoid those mistakes. So no problem. I'm happy to do it. And I hope you guys don't mind, man. I hope the sincerity comes through. It's real. But if I own a stock, I'm going to tell you I freaking own the stock. If I don't own the stock, I'm going to tell you I don't own it. Okay. But it kind of resonates in an opinion, getting investing advice from somebody who actually invests in the stock market. Yeah. I mean, that's a criteria for me. You don't sit across the table from me and earn my credibility if you can't talk the lingo of the industry that you're involved in. No way. Ain't going to happen. I can smell BS from a mile away. Technology stocks. Ryan, I get videos recommended for me warning of an economic crash and advise on buying gold. What do you think about this? 5 to 10% allocation in gold. I own a little bit of gold. I don't own any silver, or maybe just a little bit of silver right now. But cashing in your entire portfolio to opt for a gold rich portfolio is not something that I advocate for. I'm not one of those guys that's going to sit across from my audience and preach doom and gloom. I've studied the topic about hyperinflation. The biggest concern for me right now is our national debt, no doubt about it. That is my biggest concern. But it's one of those things that you have to sit back for a second and say, you know what have I done? What has the stock market done since the 1930s? Up till 2018, we may be in one of the most incredible times right now to invest in the stock market. So you have to make a choice. Either you're going to be a non-investor and you're going to sit on the sideline, or you're going to take some dollars and you're going to devote it to the stock market in the strategic manner that I talk about. Do it in the best way. Look, if you're going to lose in the stock market, lose doing it the best way, okay? And let me premise that for a second. I'm not one of those guys that are going to sit here and tell you to take every single one of your dollars and invest it to the stock market, but investing is relative. If you make $1,000 a month, or if you make $800 a month and you're struggling to make ends meet, start that account, man. Get $10 a month in there. Get $10 per paycheck, $25. Guys, that's what I did. So I don't mind giving you that information, because it's not about the $10. It's not about the $25 to devote to the stock market every month. That stuff will add up over time, right? So what if all these people preaching doom and gloom end up being wrong? Are you willing to take that chance? And that's really the question. You're not going to hear me say, I know that the stock market is going to continue to go up. But you're also not going to hear me say, I think that the stock market is going to crash or go down, or we're going to have an economic disaster. You're not going to hear that from me. Why? Because I don't know. And it's the prudent advice to tell people, look, you don't know either. So what do? You take a defensive position in the stock market. Sleep easy money over here. Keep it in cash. Buy some gold. No doubt about it. Gold, I consider a hedge against what exactly you notate there with regard to an economic crash, right? I like denominations of silver. I like junk silver. I like coinage. I'm an investor, and I'm also a collector. I'd like to add more. I think silver right now is a screaming buy, less than $20 an ounce. I would absolutely advocate for adding 5 to 10% to your portfolio, but I certainly wouldn't recommend any more than that at the expense of owning good quality blue chip stocks in your portfolio, or a good passive ETF in your self-directed account, guys. And I don't want you to forget the value of that account. Okay. I'm the only guy talking about it. You're not going to watch any type of financial institution advertising. Okay. You got Ken Fisher on TV, basically talking down to people all the time. You've got every financial manager on TV telling you guys that you can't do it. And I'm going to be the voice of reason and tell you that you absolutely can. And you don't need any of that BS, none of it. Just direct connect yourself on these investment dollars over here that you feel comfortable with investing. That is the key. If you've ever been curious about the stock market, look at getting the correct account started. That costs you nothing. Zero. Costs you nothing. Start the account. Sit on your decision for a while. Don't invest 1 red cent until you get that account started and you start that budget. That's going to be another video that I'm going to forecast here coming up. Is somebody hit me up and asked me for some budget tips on how to save money. Stop spending money. Okay? Stop. Yeah, you guys can't understand how frugal I am as an individual. We don't eat out at restaurants. We don't do things like that. We don't spend money frugalously. We don't live below our means by any means, but I think it's fair to say we live at our means. But kind of stay tuned for that video. I'm going to help you try to identify within some of your guys' budgets, right, where you can maybe piece out $25, $50, because like what I'm saying is, it's not about that $25 when you start. It's about going from thinking that you can't do it to the mental conditioning of 25, 25, 25, 25. And you know what's going to happen? Sooner or later, you're going to have a switch go off in your mind, and you're going to actually yearn to invest more. That's what you're going to do. That's what you're going to do. You're going to identify when the stock market is recessed down 20, 30, 40%, and you're going to say, you know what? I just got my tax return, right? Now I've got a good drop point to say, you know what? I think the market's at a good buy point. I'm going to drop $1,000 on here. You know, I got a refund of $2,000. What do most people do? Most people go to Walmart and buy the, 88-inch TV that you can hang on your wall. That's, the size of a movie theater. Maybe take $1,000, pay yourself first, Tony Robbins, right? Pay yourself first, and now you've got a really good bucket to drop some of those dollars in when needs be. If it's not a good buy point, then put it in your savings account. You're good to go. But at least you have that account started to where when you are comfortable with entering into the stock market, it's not so jarring when you take 50 grand and just dump it on the stock market now at a record high, which is fine because you can't time the market. But if it does adjust down, it's going to be that much more. It's going to cut a little bit deeper if you're watching that big of an amount adjust down, as opposed to deploying the dollar cost average strategy and just deploying a little bit every month. Guys, you're going to be amazed at how fast you get up to that $1,000. And when you freaking do it, pat yourself on the back. What I remember to the day when I made my first $10,000, that meant more to me than anything. You want to know why? Because when I started, I thought it was impossible. And I'm telling you, it's possible. It is possible. If you just start the mental conditioning of getting that little bit put in the bucket that I'm talking about in the manner that I'm talking about, you're going to buy low and you're going to buy some high. But over time, those dollars are going to add up, and it's going to add up quick. Trust me. I've since made a lot of different income levels past that, but there hasn't been any for me that was any more fulfilling than the $10,000 mark, honestly, guys. And I'm sorry if some of this lingo is scary for you, but there's not one person in my audience that I feel can't do it. No freaking way. No way. If you just look within, right, and look for that little bit of spark, you can find it. You can find it, and it's possible. Tony Robbins. Yeah, there's some killer videos online, man, of Tony. Pretty awesome stuff. Something that produces something, yeah, than gold. Yeah, gold. That's a good question, and I'm not gonna rain on anybody's parade. Silver's actually high on my list for investing, so I appreciate the question. I was actually, like, a few months ago, I had my money in mutual funds and was completely unaware of the fees I was paying. Yeah. Okay. Thank you, Ivan. I believe that's right. Or Yvonne, one of the two. Thank you for that question. Expense ratio is one of those terms that if you're new to the stock market, we need to exploit this information. Exploit it. Okay. Because with all the hidden fees that are much more difficult to identify within the financial disclosure, expense ratio is actually very, very easy. It's on the very front page of every single disclosure. They have to tell you what the expense ratio is. And some of those mutual funds are carrying expense ratios 1-2 basis points. A 2% expense ratio, guys, over a 40-year investment cycle is going to cost you hundreds of thousands of dollars. Hundreds of thousands of dollars. If you don't believe me, cross-check my math. Go ahead. I've already done it, okay? And the mathematics just don't lie. And that's why I invite financial planners to come on the channel, honestly. And please, if there's something that I'm missing in the program, please let me know. But I'll premise this. I've been with 4 financial planners in my life, and every single one of them helped me get where I am with regard to my education. But I tell you what, when I left every single one of them, it was the best decision I ever made. There's no way that I ever felt that being with a financial planner provided me any type of strategic edge to the stock market. No way. I feel that way now. I absolutely feel like I have a strategic edge because I'm paying myself. And that's a strategic advantage that I will take to the bank every single time. And I'm trying to empower others to really kind of understand the value of it. Luckily, I found out about you through YouTube and have eliminated the middleman. I think that's what you meant to say. That's awesome. It's great. Share the information, man. I mean, I'm not trying to build my channel on the backs of my subscribers. Honestly, all I'm trying to do is share the information. Now, I will premise you this. If you talk about watching YouTube and getting financial information, you're probably going to get an eyebrow raise, and somebody's going to be like, are you crazy? You can't trust anybody online. I don't know, man. It is what it is. This is a platform where I'm reaching close to 3,000 people right now. I couldn't have done it in a million years using any other platform. So YouTube and me fits like a round peg in a round hole. It's that simple. So share the information, and I'm glad I can help. Thank you. That's awesome. How many stocks should one own? Naela hit me up. That's a really, really good question. I have 10, all different sectors. Do I keep adding or start adding to the 10 that I have? Thanks. It would kind of depend on whether or not you have a good fundamental base. I've dealt with Nyella in private as well, and I think we've got a pretty good handle on your particular, not getting into the details, but 10 cornerstones in a portfolio is healthy. I mean, you should pat yourself on the back. I mean, geez, you're an investor. You should be so proud of yourself, you know. And depending on what the companies, I think you're up in Canada, so you have some Canadian stocks as well that are fantastic names. I believe you've got some U.S. exposure as well, but it's relative to everybody. And I wish I could tell you there's a magic number. There's of course not, but I want to make sure that some of your portfolio, and let me speak in generalities. I don't want to speak specifics about somebody's financial plan, but certainly to address, there's always room for improvement, okay? And that's really one of the key takeaways, is that you're always looking to evolve without tinkering too much, right? If there are stocks that you regret buying and you shouldn't have bought them, get rid of them. Get rid of them and enter into quality names. I've got my portfolio tooled to where I'm so satisfied. I don't look at it that much. And I worked really, really hard in 2017 to take some of my profits and put a lot of those profits to work in the manner that I wanted it set up for the long term. Okay. So this short-term volatility, yeah, is like not really that cool. I mean, I'd love to come on here and be like, yay, all right, we're up 20%. Yay, everybody celebrate. But there's who cares? And that's, again, I can't help but to dump on some other YouTube channels, but it seems like they grab the information of the day. North Korea is going to drop a nuclear bomb on the US, you know, and that's their YouTube video. And the underlying premise to that is the scare tactic. And I don't advocate for that. I don't invest in that manner. I don't believe in buying into that at all. And I don't believe putting it through the airwaves just to gain subscribers. But I wish I could give you a better answer to that question with regard to how many stocks you should own. I think it's really relative to what your entire portfolio has to offer. And I would love to see the majority of your base in passive assets. And I believe yours are. So you are absolutely have the green light from me to own 10 stocks. Whereas somebody that's a little more beginning in the stock market, I really wouldn't advocate trying to accumulate 10 shares with exposure to all the sectors, okay? Unless you have that fundamental baseline, like I talked about, in a 401k or a brokerage house that you've got a good amount of dollars exposed to the S&P 500 or a good dividend ETF, for example, or a total market ETF. Then you can go ahead and branch into some of those cornerstones, good dividend payers in that additional account. So speaking of national debt, should we invest in other countries' markets or currencies? Not something I'm really into. If I'm partial in my opinion to stay invested in the U.S., so be it. But Canada's very strong. Europe is very strong. The U.S. is very strong. I'm not really into investing in emerging markets. Now, I'm not going to tell you that you shouldn't take a piece of exposure. I've got some of my subscribers from India, so they have firsthand insight on how incredible some of the opportunities are there in some of the emerging markets. What I would encourage you to do if you're going to enter into an emerging market or for foreign currency, which is something that I'm actually up to speed on a little bit, it's just not something that I dabble in. I would rather own U.S. equities on the whole. And I think if you guys, I'm going to be doing a portfolio breakdown for you guys. I've done it before. I'm going to do it again, and I'm going to give you guys a firsthand look at my holdings. You guys can look at it. I'm going to provide that to you, and you guys can kind of see how I break up my exposure. But look, if I'm going to win, lose, or draw in the stock market, it's going to be through U.S. equities, man. It's going to be through. We're the ones that are innovating. We're the ones that are coming out with companies like Google, Facebook, Apple computers, which I talked about. India, investing in Apple computers is, in an essence, investing in India, and I'll just leave it at that. All right. Thank you for your response. Love the channel. Focus on growing my Roth IRA with blue chips. Good way of doing it. My blue chips will probably go to my kids someday. Apple, J&J, Exxon, JP Morgan, Coke. I just bought within the last month on my recommendation. GM is going to turn around. Sorry to tell you. Should it be a primary industrial holdings? I like UTX better, but I picked up GM as another diversified industrial. Sorry, I get GM and GE screwed up. I'm sorry. GM is phenomenal company on the autonomy side of the house. GE I recommended, took a little bit of heat for it this week, and I apologize for that, but I do own the stock. I own 150 shares, couple $1,000 position. I do see the stock doubling within the next couple of years after you get anything. Golffish is one of my original Plank owner subscribers, giving me a shout out from Houston. Love the videos. You have any plans to do a tax recap video for this past year? I don't hear much from active Robinhood traders on the topic. Yeah, and that really speaks to the root of what I addressed at the top of the broadcast, in that, you know, when you get into Robinhood and your incentive is to trade in and out of stocks for free, unfortunately, the premise there, people think, is that they need to enter and exit positions all the time, right? So it's going against the fundamental philosophy that I teach upon. So if you rack up 50, 100, I've had folks hit me up and they're like, I'm up to 200-300 transactions, Ryan. What do I do? And I said, well, first of all, you need to figure out how to upload your Robinhood statement into your 1099 divs into your tax software. That's the first thing. You have to do that. But you've created a ton of taxable situations with every buy and every sell that you've come out with. And that's kind of one of those things that I'm trying to help you guys with. I've already made that I've already made that misstep, right? And I won't do it again. You do not underestimate the tax man. Don't. And I've had a lot of people hit me up. Well, yeah, Ryan, the tax savings isn't until, you're 59 and a half. Look, guys, I'm looking to make it to 59 and a half. I don't know about you guys, but I'm not investing to make money and put food on the table now. That's not my goal with my money. My goal is to retire with financial security. I'm open and honest with you guys about my financial goals. But for you guys, with regard to the Robinhood and the tax implication, I would be very, very careful with racking up these free trades and coming at me and saying, Robinhood's free, Ryan. It's the best thing since sliced bread. Yeah, wait until the IRS knocks on your door and they send you a fat tax bill because you've entered into and exited positions 200 or 300 times during 2017. And I think that's going to rear its ugly head here within the spring of 2018, when a lot of people realize, oh my gosh, now I see what the problem is, and didn't really utilize Robinhood for the intention that it was supposed to be utilized for. Hey, Ryan, I'm a big fan. Thank you. I'm a normal guy. Okay. I'm helping and I'm talking about my favorite topic. I'm going on an hour right now and I'm going to shut this down after an hour. But I could talk about this all night. I would love to talk an extended session with you guys. I actually had a goal of doing this in 30 minutes. It's impossible because you guys all have excellent questions. One thing that can help me is hit me up. If you don't catch this broadcast, hit me up in the Facebook group, because if somebody of my plank owners to the Facebook group don't hit you up and address your question, I monitor it very frequently, and I tend to respond to everybody that gets on there. So please hit me up with your question if you don't have a chance on this forum to hit me up through the Facebook group. I'm going to help anybody that's willing to learn. That's my only criteria, is that you're willing to learn a little bit and hear out an opinion from somebody that's sincerely trying to offer that opinion to help folks. All right. Ryan, what's ETF considered more aggressive? Spiders. I mean, if you're looking to get into ETF investing where you're looking at exposure to a specific sector, I mean, I'm getting beat up, for example, in VPU right now, which is Vanguard's utility ETF, and I'm getting whacked. I'm down 13%. Am I holding it? Yeah, I'm holding it. It's a 3% dividend payer. I'm fine. It owns some of the best names that I want exposure to, and it's only 3% of my portfolio. So That's just my opinion, but you got to be kind of careful, man, with spider investing or specific sector investing, as it's a much more aggressive way of investing. Guys, I consider single stock as being an aggressive way of investing in the stock market. A safer way of doing it is passive ETF investing. That's safer. Okay. So all these folks out there that are talking about, oh my gosh, you can't invest in an ETF because it's somehow risky, because somehow the stock market's going to crash tomorrow. It's all baloney. It's all baloney. And anybody who tells you that they know where the stock market's going is delusional. They're delusional. They're self-induced, right, prophecy about thinking that they're somehow a stock god. They need to get over that. They really do. And unfortunately for some of those folks, they've actually made some money, entered into some stocks, and actually have themselves convinced that they can actually buy into stock and repeat that success over time. That's planned failure. Those guys are going to end up figuring it out someday, hopefully, really, because I don't want to see ill will on anybody. But thinking that somehow that you're seeing something that 1,000 other analysts out there are not seeing, you're delusional, okay? And you need to get over yourself. If you want to participate in the stock market, buy the market. If you want to participate in the stock market, buy the market. And I'm sorry you guys had to spend 55 minutes on me to probably hear my most important message in this video, but just buy the market and don't screw around with it. If the stock market does go down, the best gauge and indicator is if your stock portfolio goes down 10%, well, then it's down percent. Maybe it's time to pony up and buy a little bit. The last thing you want to do is panic and exit those positions. But maybe adding more to that portfolio is probably a prudent move when your gauge is telling you that you're down 10, 15, maybe even 20%, right? Add more at those times, right? Add more exposure to the stock market. Really appreciate your sincerity and commitment to helping people. No doubt. Thank you. I'm humbled. Thank you. I appreciate that. Love the channel. Enjoying the live streams. Keep up the great. I started this last week, and I just clicked the button to start doing this. I apologize for the raw approach. That it's so much better, I think, if it's a little bit less scripted. And that way I can just talk to people. And that's really what the intent is. Hey, Ryan, I max out 2 IRAs a year and do the company match on my 403B. One IRA is all VOO. Other one I buy stocks with, but only a few shares of any company. How am I doing? Phenomenal. Phenomenal. You do exactly the same thing, except for your 403B, which is great because you always want to take that free money that they're giving you from your company. So thank you, Tony, for that question. I have an equivalent, as many of you guys know, with my military affiliation, right? I'm with the TSP. So the 403B is going to be the comparable retirement pension for you. Take the matching on that. And then your IRA, you've got 2 IRAs. So I don't know if I'm assuming that you have a traditional and a Roth, or if you have 2 Roth accounts for you and your spouse. But it's fantastic. And it's interesting because you guys can all learn what Tony's doing there. Is he's got 1 IRA with all VOO. That's all you need. It's all you need. Simple investing. I actually believe I've passed that a couple times on my video dialogue when I actually talk about the simplest thing you can do is pick out a self-directed Roth IRA account, stick an S&P 500 index fund in there, and you are investing. And you're cutting edge above so many people out there who think that they can beat the market, or strategically thinking that they can take as many sheep as they can and herd them where they want them to go. Guys, I can't get that. It's so irritating. And I'm so glad that the Independent Investor channel exists. And it just so happens to be that I'm the one that's doing it. But gosh, as a community, we can kind of try to buy in to some of these fundamental philosophies, man, because just by doing that right there that Tony's talking about, you've got the entire S&P 500 index. You own Amazon, Apple, JP Morgan. You own all the major companies, right? 500 of the best companies. And one of the interviews that I put on the Facebook page is J.L. Collins broke it down in this manner. He said, you own the S&P 500. He said, a company can only go down 100%, but a company like Google, Facebook, they could go up thousands of percent, right? Amazon has gone up 35% since its inception, 35,000%. So if you're invested in the S&P 500, you're taking part in that little bit of appreciation. Now, if you're not invested in the VOO and you're invested in this suite of stocks over here, let's say 10, then you're missing out on some of that appreciation over here on some of those stocks that you would have never thought to invest in, right? And so the bygones kind of get filtered out of the S&P 500 and new stocks get introduced as those non-solvent companies get rotated out. And the S&P 500 is always going to be reflective of those companies that are making the highest amount of profits. Not only that, but you're going to participate in the knowns like an Amazon, but you're also going to participate in those stocks like Newell Brands that have got beat down, but are probably going to be the outperformers next year, right? You can't always buy the performers and expect that the performers are going to outperform going forward indefinitely, right? You have to account for those non-performers or dogs. And the only way that you can participate in both is to buy the entire index. Just buy the entire index. So thank you, Tony. That's an awesome question, man. Awesome. Don't try to force the stock market. Just buy and hold and go with the flow. That is absolutely fantastic advice. You have to, investing has to mean more to you than the dollars and cents in that account. It has to. Being an investor, saving for your future, participating in the correct manner, right? Calling yourself an investor, patting yourself on the back and giving yourself some credit for giving up that one meal at the restaurant per week, right? If you show a little bit of discipline, right, and you're able to piece out a little bit in that budget, right, then you're being responsible the way that you're supposed to be responsible. And I know Ramsey talks about being in the US, and if you can't save in this country, guys, if you need some perspective, go abroad. Go abroad. I've done it. Even when I go to Europe, right, it's a completely different feel, you know? I mean, folks don't have the opportunity to save money. We do. We do. So if you don't have the fortitude and the opportunity or the foresight to save in the US, you're missing out, okay? You're missing out. And I'm here to tell you that you can do it, all right? So awesome advice, man. Awesome. Are Roth IRA accounts automatically self-managed? Yeah, they are. If you call and try to get them to put you into a self-directed account, they're going to try to upsell you into a managed account. So by default, if you go in there and you say, I'm interested in a Roth IRA, they're going to put you into a managed account. No doubt about it. Okay. They're not going to actively promote the self-directed unless you're educated up on it. And it's very simple. With the education that you get on the independent investor, you're going to know the difference between self-directed and managed. You're going to know that difference. So they hate guys like me, straight up. They hate us. And it was funny because ironically, I was sitting in Bank of America just last week trying to deal with an issue. I hate going in banks, man. I hate it. I just feel like I'm walking into a freaking evil house, man. But I ended up sitting in front of, guess who? The Merrill Edge rep, right? Everybody knows my brokerage is Merrill Edge. And I asked him, I said, first of all, I asked how old he was. 23 years old. So with his vast experience in the stock market, and he didn't know who I was. Hopefully he's watching the live feed because I turned him on to the channel and he was like, that sounds really interesting, man. It sounds like we think alike. And it was like, yeah, well, I'm 40 years old. I probably have a few decades of experience on you, and that's okay. You know, I'm sitting in front of people doing financial plans for them. But I said, what type of account do you have? And get this, he says, it's a self-directed account. So, you know, like he's selling managed accounts to people, but the very account that they allow their employees to have is the self-directed account. I'm just like, oh my God, like pull back the screen for my viewers. I had to get that in. I had to plug that, man, on my video. That was so funny, man. So I love VOO and VYM. Yep, I got that ticker symbol right. Thank you, Jared. Yeah, I know you're an avid investor in those particular ETFs. And you were actually the one that brought my attention to the VYM. That's actually got a better year-over-year return than VTI. So thank you, Jared. He's a member of my Facebook group. one of the very active plank owners in the group. And I expect when I'm not monitoring that group that somebody out there in a different time zone honestly is going to pick up and give some advice. I'm so excited to see some of the advice coming from some of the folks who would answer the question maybe even better than me, right? If I answer the question, it's going to be to the best of my ability. But sometimes some of the answers that come through on the Facebook group, I'm like, wow, that's a killer advice, man. And it's advice that you can get 24 hours a day, 7 days a week, man. It's like 7-Eleven and never closes. Never. You could never, ever get that level of service from a financial planner. Never. You'll never get that type of experience because the intent of their program is so different. They want to walk you down this path, and I'm trying to tell you to avoid that path at all cost, right? Put yourself on the unrestricted path, man. I'm pulling from one of my videos, one of my non-popular videos, I might add. It's one of my best videos, I think, man, where I talk about the different paths that you can put yourself on at the crossroads of investing, man. So I'm going to take a couple more questions and I'm going to wrap it up. I've been going for an hour and 5 minutes. So I tried to keep it a little bit lighter this Friday. We will be doing this every Friday if time permits and if my opportunity permits. But I'm going to take a couple more of my last questions and then I got to wrap it up. This will be posted online certainly for review. If I talked about a certain topic, you can kind of go back and review it. But just in closing, I want you guys, if you have not joined the Facebook group, kick over there. There's some killer stuff going on, man. People educating themselves on the power of putting themselves in charge of their own finances, no doubt about it. And by doing this, it puts them in charge of their money. But even more important, the dollars that are earned within those accounts are preserved over the long time for individual investors. All right. So last couple, man, thanks for the advice. I'm 17 and I'm trying to save up for a self-managed Roth IRA so I can open one when I turn 18. You are the very person that I'd hug you if I was with you, because you have found a channel that I wish I had this information when I was your age. I wish I did. So don't get caught up in the noise, okay? Continue to save and invest that capital on the side. Don't get overzealous, okay? I don't want to give you advice to where when you're my age, you've got the money to go buy a Corvette, okay? I want you to stay long in your program, but I want you to realize that self-directed Roth IRA account will be with you the rest of your life. I will say it again. It's very rare that you can say that about a particular account that you can open and keep for the rest of your life. This will be the very fundamental account that you will refer to when you're 20, when you're 30, when you're 40, 50, and when you finally reach retirement age. You're going to be so glad, and you're going to remember the time that you came across the Independent Investor channel, man. So someday hit me up and say thanks. It'll mean the world to me. It really will, because it's life-changing information, life-changing, no doubt. So thank you, Will. I appreciate that, and good luck to you. Do not hesitate. Join the Facebook group if you haven't already. I want to see direct questions with regard to your situation. I will take care of you, all right? Because you represent our nation's youth, and you guys need to share this information with your networks of folks, because in my particular opinion, the way that I invest in the stock market, there's no comparison to any other program. None. Zero. There's a correct way, and there's a lot of misconceived wrong ways out there. All right. Dollar cost averaging all my holding for the long term, but lots of bad news and bears coming out of hibernation. Might there be some good sales ahead? I think there's some value in the stock market now. Disney is one of them. Kraft Foods is one of them. Tractor Supply has come down a lot. ExxonMobil is one of those. General Electric is one of those. Now, I kind of addressed this at the top of the show here. Home Depot is a good one. There's only a few of these really, really good stocks that I recommend in a sector that are going to meet the requirements for somebody who is just starting in the stock market, all right? So if you're just starting, you do not need to look a whole lot further than the cornerstones, all right? So if you want to start a portfolio and your goal is to build up, I would really love to see you get that passive baseline in place with one good ETF, okay? So get the ETF in place. But if you want to talk stock right now with me, look no further than Apple, Computers, Wells Fargo, Procter and Gamble, which is actually a good buy right now. Johnson and Johnson, I would add to that mix. All right, so we've got all the sector exposure there. The last one I'm going to leave up to you. You could pick it from healthcare. I'd recommend looking at either Pfizer or Merck in healthcare, or you could add Disney. Disney would be my fifth one. Those would be my 5 stocks that I would look at right now. And your question is a genuine and it's a valid one, but don't ever think that you're going to get the optimal entry point into a stock. It's not going to happen. Those stocks that I just talked about, it doesn't matter what the stock market's doing. You're always going to pay a premium for those stocks. And you may be getting a discount in some of them. Disney's pretty recessed. It's at a 52-week low right now. Apple's come off of its highs. Disney's a good buy. Wells Fargo's come off of its highs, so you're getting a good entry there. But sit on those dividends, man, while you're enjoying owning those good quality stocks in that self-directed bucket. And I gotta get Kathy. Great info, guys. Thank you, Kathy. Very devout subscriber, loyal subscriber, and I appreciate it. I hope you've utilized the information for you and your family, no doubt about it. Great stream, honest, real information. Appreciate your time. That's a good stopping point. I appreciate you guys. The strength of the channel, I always turn back to the strength of my subscriber base. No doubt about it. I said it many, many times. I don't care that I have 100,000 subscribers. If I've got 300 or 400 people that over the last year I've been able to reach with my message, and the message resonates insofar as you take the information and utilize it and deploy it to strengthen your guys' financial positions in your own personal lives, then we are making all the difference. We are making all the difference in people's lives in realizing the goal of the channel that has been since the beginning and empowering individual investors. I will take one more. It just popped in there. This will be the last one. Having cornerstones as your core holdings in your portfolio is very important for the long term. I agree. I agree. I think you're giving up a lot of potential returns in single stock allocation. What I would like to see you guys do is do both. I'd love to see you with a passive approach as well as add those cornerstones in that portfolio. And back to my 17-year-old, soon to be 18-year-old, I'd love to see you step into this realm as soon as you feel comfortable doing so for your own lives. Guys, thanks for tuning in to this Friday stream. We're going to be making it a regular thing. Thank you so much for the engaging dialogue. That's what makes it the strength. Hopefully you've heard something that's resonated with you, and you can go ahead and take that and deploy them in your guys' own financial future, guys. Again, thanks for tuning in with me. I really appreciate it. Good luck in your investment future.